97%. Not of beginners. Not of the people who tried it for a weekend and walked away. 97% of the traders who stayed. Who studied for 300 days. Who took the losses and came back the next morning and did it again. They still lost. And here's the part that should bother you. It wasn't because they were stupid. Most of them were smarter than average. They read the books. They followed the rules. Some of them even had winning strategies. And they still lost. So if it isn't intelligence, and it isn't effort, and it isn't even having a good strategy, then what is it? What takes 97 out of 100 people who refuse to quit and beats them anyway? There is an answer. It's specific. It's provable. And once you see it, you can't unsee it. You'll notice it in every trade you've ever lost. But I'm not going to tell you yet, because it won't mean anything until you've seen the two things underneath it. So let's start with the first one, the person sitting on the other side of your trade. Let's kill the first excuse, because you're already making it. You're thinking, the people who lose are the ones who quit too early. The weak hands. The panickers. I'm not like that. I'm disciplined. I'll grind through it. Here's the problem with that comfort. That 97%, it only counts the grinders. The study followed traders who stayed in the market past 300 days, the disciplined ones, the ones doing exactly what you're planning to do. 97 out of 100 of them still walked away with less than they started. And it gets worse the harder you try. In a study of 66,000 households, the traders who traded the most earned 11.4% a year, while the market handed out 17.9% to people who did nothing at all. Effort didn't protect them. Effort cost them 6.5 points every single year. And it scales. Take the most active traders of all, the ones churning their account over and over. After costs, they lose more than 10 points a year to the market. The more you trade, the faster you bleed. The gas pedal isn't your friend here. It's the leak. You'd think they'd learn. They don't. Follow them long enough, and the crowd thins fast. After 1 year, 44 out of 100 are still trading. After 2, 24. After 3, just 15. And the ones who stay? Their results after their first 250 trades look exactly like their results before. Experience didn't teach them a thing. So the grinding doesn't save you. Which means the thing beating these people isn't up here on the surface where effort lives. It's underneath. And the first layer underneath is this. Every single time you place a trade, someone takes the other side of it. Every time. And that someone is not your equal. Day trading has a feature that long-term investing does not. It's a zero-sum game. For you to win $1, someone has to lose that exact dollar. There's no growing pie here. There's a pot, and it just moves from one side of the table to the other. So sit down at that table and look at who's already there. On one side, you, a phone or a laptop, retail money, reacting to a green candle you saw 4 seconds ago. On the other side, institutions, Algorithms that place and cancel thousands of orders every second. Market makers who can see the flow of orders before it even fills. Firms with more capital, more speed, and more data than you will ever have access to, sitting on the opposite side of your click. So when you buy, someone sophisticated is usually the one selling to you. And when you sell, in a panic, at the bottom, at the worst possible second, someone is calmly buying it from you. Not because they got lucky, because their entire business is built on being on the other side of you. Now, this is where most people get angry and say the market is rigged. It isn't rigged, and that's the wrong word, because it lets you off the hook. The table is legal. It's public. Anyone can sit down. But sitting down at a table where everyone else is faster, richer, and better informed, and expecting to win by just trying hard, that isn't a rigged game. It's a misunderstanding of which game you're playing. And that misunderstanding costs money in a very specific way. Between the spread, the slippage, and the fees, you pay a small tax on every single trade. A tax the institution on the other side barely feels. And you feel every time. The more you trade, the more tax you pay, which is exactly why the most active traders bleed the fastest. Here's how big this gets. Add up every regular trader in an entire country for 1 year. In Taiwan, researchers did exactly that. The whole market, every trade. What ordinary traders lost was bigger than everything the nation spends on clothes and shoes. 2.2% of the entire economy. Gone. Every year. And that money didn't vanish. It moved. Straight across the table. The regular crowd lost about 3.8% a year. And the institutions on the other side gained about 1.5%. Added up, and what the institutions won is almost exactly what the crowd lost. It's not a mystery where your money goes. It has an address. And here's the twist. Nearly all of those losses came from one thing. Not from patient orders. Those actually did okay. Almost every dollar the crowd lost leaked out through their aggressive orders. The panic, buy it now, the get me out. The market order you fire when you can't stand it anymore. Your worst click isn't a side effect, it's the whole channel. But here's what's strange. Even if you fixed all of this, even if you had the speed and the data and sat on the winning side of the table, most of you would still lose. Because the second layer isn't out there at the table. It's inside your own head. And it fires on a schedule. Here is one of the most reliable numbers in all of behavioral finance. People sell their winning positions about 1.5 times as often as their losing ones. It shows up in 10,000 real accounts, and it barely changes no matter where you look. Sit with that for a second. When a trade goes up, you sell. You grab the small win. It feels safe. It feels smart. When a trade goes down, you hold. You wait for it to come back, because selling means admitting you were wrong. So you cut your winners short and you let your losers run. Which is the exact opposite of the one rule every profitable trader lives by. This isn't a flaw in you, it's a flaw in everyone. It has a name in the research, And it turns up study after study in every market, in every country. Your brain evolved to feel a loss about twice as hard as it feels the same size win. 100,000 years ago, that fear kept you alive. At a trading screen, it quietly empties your account. And it gets more specific than that. The moment of maximum pain, the very bottom, when the position is deepest in the red and every cell in your body is screaming at you to make it stop. That is the exact moment the panic becomes unbearable and you sell. Which is the exact moment the calm money on the other side is buying. Your worst decision and their best entry are the same event. So where does all this constant trading even come from? One word: overconfidence. And we can measure it. Men, who the research shows are simply more overconfident about money, trade 45% more than women. And it costs them. Their trading drags their returns down by 2.65% a year versus 1.7% for women. Single men, they trade 67% more. The surer you are, the more you trade. And the more you trade, the more you hand over. And here's the cruelest part. After a loss, you don't stop. You trade more to win it back. Revenge. And that overconfidence barely breaks. Follow the unprofitable traders, and about 95 out of 100 are right back at it the next year. People ride years of red, still certain the next one turns it all around. Confidence is the very last thing to go. So now you've seen both layers, the table you can't beat on the outside, and the brain that betrays you on the inside. And that, finally, is where the real answer lives. So here it is, the answer I promised you at the very start. The reason 97% lose, even the ones who never quit, is not the table, and it's not the brain. It's the combination. The market is a machine built to feed on the exact mistakes your brain is wired to make. Look at how perfectly it fits together. Your brain panics at the bottom, and the structure keeps calm capital right there, ready to buy from you. Your brain cuts winners and holds losers, and the spread taxes every extra trade that mistake creates. Your brain trades harder after a loss, and the zero-sum table simply takes more. These aren't two separate problems. The outer machine is shaped to profit from the inner flaw. It doesn't need to cheat you. It just needs you to be human and to keep showing up. And that is why effort makes it worse instead of better. Every hour you grind, you're not escaping the trap. You're feeding it more of the one thing it runs on: you. Now, I'm not here to tell you nobody ever wins. About 1 in 100 does, consistently, over years. And their edge is real. It holds up. But look at what that 1% actually does, because it's the opposite of everything the 97 do. They trade less, not more. They take small losses fast instead of clinging to them. They sit out when there's no edge. In other words, they spend all their energy fighting their own brain. Not the chart. The chart was never the real opponent. The person in the mirror was. So the real question was never, how do I read the market better? It was, Can I do the one thing my brain is built to refuse? And the honest version of that question is worth more than any strategy anyone will ever try to sell you. If this made you look at one of your own losses differently, that's the whole point. There's a full breakdown of the psychology piece coming next. That's the layer that beats most people. I'd start there.